So we just finished recording an awesome podcast. That's gonna suck. I'll cut this part out. All right. So we'll say we'll say all right, on the upcoming episode that you're about to listen to, we have an amazing guest that has grown a fantastic portfolio. She has single family homes. She's got duplexes, triplexes, 10-unit property. She just finished syndicating a 64-unit deal, raising private capital, all kinds of crazy stuff. James, are you motivated or what after listening to that?
I'm motivated to go out there and find some money because it's on the table. You just got to meet the right people to go find it. I think we learned a lot about growing your network, finding partners, getting deals done. Soli was really able to scale quickly through the pandemic with her business, and she gave us just too many actionable tips to count. So I think our listeners are really going to benefit from this one.
How's it going, everybody? And welcome back to the Real FI Podcast. I'm your host, Patrick McGrath, with my co-host, James Ripion. How's it going today, James?
It's going well today, Patrick. I'm super excited about today's guest. We got Soli Cayetano here with us, and she is, if you don't know already, a heavy hitter all over Instagram, working with bigger pockets, and she's got a wealth of knowledge to share with us. So if you don't know her, she's on Instagram as Lattes and Leases. Definitely give her a follow. But without further ado, Soli, why don't you introduce yourself and tell us some of the things that you've got going on in your business and with your life?
Sure. Thanks for having me, guys. I'm excited to be here. I am a 25-year-old out-of-state investor. So I am based out of California, and I invest primarily, I guess, only in Ohio and in Georgia. So Cincinnati, Ohio, and then Augusta, Georgia, where the Masters tournament is, if you know about it. I do a combination of single family and multifamily, and I have a combination of short-term rentals, midterm rentals, and long-term rentals. But primarily the strategy that I'm known for right now is doing the BRRRR strategy with private money on single families. So that's the current strategy.
That's crazy. I love the strategy, and I love how you were able to pack all that into like 2 minutes real quick. But let's walk that backwards a little bit and tell us how you got started to where you are today.
Yeah, so I started investing in the pandemic. I was 22 years old. I was a senior in college. At the time, I was working in commercial real estate. So I was a commercial real estate broker, started really young. And then the pandemic hit in, I guess, spring semester of college, and school kind of shut down and work shut down because I was office leasing. So no one wanted office space in the pandemic, as you can imagine. But I had a lot of time. I was used to like working double jobs and working 80-hour weeks, and finally just had nothing to work on and had time to reprioritize my life and think about what was important to me. And I really started focusing on building passive income through real estate investing. So that's when I decided to invest in real estate, and I never got the chance to give myself analysis paralysis. By the time, I think it was like 12 weeks after I made that decision, I closed on my first property, and like the rest was history.
That's incredible. So is
Wow.
that where your Instagram handle came from, doing commercial leases, your prior life and doing that kind of work?
No, actually, I used to work at a coffee shop. So I started working super, super young at 14 years old. I worked in a local coffee shop for 5 years, from like 14 to, what is that, like 19, and loved coffee, drank too much coffee. And so thought about like, what did I like the most? I liked coffee and I liked real estate. So it was like a little catchy thing. Never thought that it would catch on, thought it would just be like my mom following me on Instagram, but really started to blow up after I bought my first property.
Love it. Well, let's
That's
rewind the clock a little bit and talk about that first deal, because you got into the market at a very interesting time. COVID's happening, businesses are slowing down, shutting down, a lot of uncertainty in the world. So talk to us about that first deal. What did you buy? What did you buy it for? What did you do to the property? And do you have it now, or have you sold it?
I still own it. It's a single family property. I bought it for $98,000 in Cincinnati, Ohio. I didn't know that houses that cheap existed coming from California. I live in like San Francisco Bay Area, so everything is like $1 million plus. I actually flew out and saw it. So prior to buying it, I bought it sight unseen, pretty much off the internet with the help of a realtor. And then I flew out for, I think, for a month, and I learned how to DIY projects, the first and only DIY I will ever do. But yeah, $1,000 into it. It appraised for $55,000 later. Probably help from the market, since the market was really ripping. And as you might probably remember, like super competitive, appreciation was going crazy. And so I was able to almost perfectly burr that property. And I still own it today. It cash flows over $500 a month, which is amazing. And I actually also self-manage it.
That's great. That's great. So you, within 12 weeks, you got your first deal and then you burned it. You got all of your money back. So during that 6 months, did you buy any other properties? Because a couple minutes ago, you were telling us like your portfolio got like pretty big in the last 2 years, you know.
Yeah, I
Uh,
guess I forgot
so
to mention, did I tell you how many? I have 35, and I'm closing on the 36th unit on Monday, actually. But I scaled really quickly. So I bought 4 units within that 6-month time frame before I actually refinanced. And I didn't have any money pretty much after that first property. So I actually learned the skill of raising private capital for my second deal. And then for the third deal, that family member ran out of money. So I learned how to use hard money and partnerships for that next deal. And I ended up in 1 year buying like 25 units. So like incredibly fast.
that is absolutely amazing because most people will buy that one, they'll wait the 6 months, they'll refinance, then they'll start looking for the next one. And it'll take them 2 or 3 years to start building up that confidence to really start scaling. I mean, I know we've really been doing it for the last 3 years and we just hit 35 units. So we're right there together. But what piece of advice would you give that person that is looking to start or maybe has 1 or 2 properties and is looking to scale? Because you just went out the gate and just in 12 months bought 25 and had, basically did every single thing that a long-time investor would take a couple of years to even feel comfortable doing. You just went out swinging like, why not do this, you know?
Arguably, I like maybe it's smart to wait a couple of years to actually learn your lessons and then grow. But I guess impatience is my best and worst quality. So we scaled really fast. But I would say before you scale, make sure that you have the right systems in place. So make sure that you have the right team. I'm an out-of-state investor. And so if I don't have the right contractors, the right realtors, the right property managers, then my whole business falls apart. And if you start to scale too quickly on top of that, you're just waiting for the whole thing to crash down. So definitely felt some growing pains, had to learn to hire and fire contractors really fast, had to learn to fire property managers and kind of build along the way. But a lot of great lessons coming from that year of growth.
So I'm kind of curious, and I'm going to put you in a position to answer probably a really difficult question. And it's probably going to take a little bit of guessing and hypotheticals. So if you were starting out today, and I'm not going to say like, could somebody else do this? But if you were starting again fresh today in today's market, after the rip in prices that we've seen, do you think you would be able to repeat what you've done to get from 0 to 35 units as quickly as you did?
Yes, I think that today's market is actually a much better buying environment. If people always have an excuse of why today's hard market to invest in, but if you remember back in 2020, interest rates were really low, but the market was really competitive. And so someone like me, I was using conventional loans. I was not an all cash buyer. I was like, didn't have much experience. And so trying to win those properties, I was competing against, very wealthy out of state investors who could buy all cash. In today's market, there's a lot of houses that are sitting on the market because they're overpriced. We're finding that there are a lot better deals out there. And I think that it's probably an easier market to buy into, even though interest rates are higher.
I agree with that 100%. I
I
think,
agree with that.
yeah, because in my work, because I'm a real estate agent, and right now things are lingering a little bit longer than they did. And I got into it just about the time that you were starting to do your real estate business. And things are crazy. Things are crazy. You're competitively going over asking, just for the retail side of things. So it made buying things very difficult for investors. So, with the increased interest rates, it might be scaring off, a couple investors here and there, just because of the fear of not reaching cash flow numbers. But the fact is, properties are staying on the market for longer, and that is simply just opportunity. Maybe that's a sign of a healthier market too.
Yeah, you marry the house, you date the interest rate, and so the interest rates stay. You can always refinance down the line, and cash flow today is going to increase cash flow in 2 or 3 years. And so, as long as they cash flow today and we're buying at deeper discounts, I'm happy with the properties we're buying. We're buying somewhere between 2 to 5 single family houses a month, and so we're finding a lot of great deals right now.
Is that your primary focus? Because I know you did mention that you got into some multifamilies. So one, is your primary focus now the single families? And two, could you just break down what your portfolio of those 35 units looks like? Like, hey, it's majority single families, but I have a duplex, a 10 unit, or whatever.
Yeah, I have a 10 units, the biggest one, a 5 unit, a triplex, couple duplexes, and the balance are single families. The reason why we focus on single families is more so from an inventory perspective. So we kind of switched. There's a lot of multifamily properties in Cincinnati, but the properties are really, really old. So like the 10 unit I own with a partner, it's like built in 1880. And so the renovations are a lot bigger and the buildings are just not as solid quality because they're 150 years old. And so when we transitioned into Augusta, Georgia, it's a little bit, it's an old city, but a lot newer inventory. So we're buying houses that are more like 1950s. Makes a massive difference in the quality of the build. But because that market just doesn't have very many multifamilies, it's tough I would buy them if they existed, but because the inventory is single families, it's a lot easier to buy 4 or 5 single families and then almost treat them like a portfolio of single families that equals a multifamily, if that makes sense.
It does. And
Makes
what's the
100%.
breakdown as far as short-term and long-term rentals go? Is it all long-term leases, or do you have some short-term rentals working in there?
Yeah, 2 short-term rentals in Cincinnati. Those are interesting. I think Cincinnati is not really a destination city. It's not really sexy, but depending on the month, it does. Like our best month, we just launched it about 9 months ago. Our best month was like $11,000 or $12,000 of revenue, which is amazing for a duplex that's worth like $300,000. But it's very cyclical. So the winter doesn't do too well. And then we have 2 midterm rentals, and then we're launching a third midterm rental, and the balance are long-term rentals. So the portfolio is majority long-term rentals, but those midterm rentals have so much more cash flow that we will sprinkle them in when we find good deals.
Makes a lot of sense. Makes a lot of sense. Now you did say partner. So can you break down for us kind of what the portfolio is strictly on you, and then kind of how that partnership works for you guys?
Yeah, so I bought the first 4 units by myself. I was really stubborn and wanted to do everything by myself because I don't know, maybe a pride thing. And then once I ran out of money, and I honestly was only like 5 months into investing, and I didn't know that much. I knew another investor had started investing maybe like 2 or 3 years before me and had a portfolio in Jacksonville. And so I needed his money and I needed his expertise on how to grow my portfolio. And so we partnered on, must have been like 20 something units. I'm not exactly sure what the exact number is. And then I had a friend who I met in a mastermind who lives in Augusta, Georgia, and actually owns a construction firm and a property management firm. And we were talking to him about, partnering on some stuff, and decided collectively, my Cincinnati partnership decided that it would make more sense because we were having so many issues with contractors and property managers. Like, why not team up and form like a super team in Augusta? And that's what we have been doing. So we bought in the past couple months, I think we bought like 8 or 9 or so properties. And that's the partnership that I'm primarily buying in. It is way more fun to buy real estate in partnerships, even though I only get 33% of it. I think the pie is a lot bigger, and I get to work on the things that I like to work on instead of having to do everything by myself.
James, you're on mute
Sorry,
again.
sorry about that. I was going to say that 30% of a really good deal is better than 0% of no deal. So when you can involve partners, it keeps you motivated, and you can accomplish bigger things sometimes too, because all those people have networks and connections everywhere else too. And I find it really interesting that you decided to go to Georgia as a market because of the connections that you made through a mastermind. Tell us a little bit about that mastermind, how you got connected with these people, and just your involvement with that.
Yeah, it was a free mastermind, actually. Do you guys know Steve Rosenberg
I've
and
heard of Steve. Yep.
Ashley Kerr, who hosts the Bigger Pockets Rookie podcast? And so way back in 2020, when I first started, I had no properties and it was the pandemic. So nobody was hanging out with nobody. And so I wanted to join like a networking group to just be surrounded by other investors and learn more about real estate investing. And so I joined, and actually a bunch of people that I still know today joined that free group too. It was just like maybe like 10 weeks of calls that we networked. This friend partner, he started investing around the same time, but since then he's scaled to 150 units. And so when I say I scaled fast, he scaled way faster. And throughout the next, I mean, I stopped going because they switched to like a paid model, and I just stopped going. But we kept in touch because we happened to have a lot of the same growing pains, because we had both scaled so quickly that we learned a lot of hard lessons together, and he learned a lot of hard lessons before me. And so when we were dealing with the backlog of renovations and dealing with the market turning and some properties that were sitting on the market and we had to turn them into rentals and that type of thing, he was the person who I called freaking out, like, what do I do now? Because I'm just at the time like 23-year-old investor, like, what do I know? They don't teach you how to do these things in college. And so he was kind of my like mentor-ish, but also peer, because we invested at the same time. He just helped me get through some really difficult situations. And through that, we just decided to invest together.
That's great. And I'm like really excited, and also just happy that people are able to hear this story of how you did all the things that everyone talks about doing. Like, hey, joining a group so you could be around like-minded people, finding a mentor or someone else going through the same things that you're going through, and just bouncing ideas off of and working through it together. Buying all the properties yourself at first, because of a pride thing. I'm kind of in that same situation too. And then realizing a partnership is going to help you, do all the things that you're good at, which is raising money and focusing on that, and finding deals, and then pushing it even further, and basically taking what I think a lot of people would try to accomplish in a lifetime of real estate, and be able to do it all and compress it down into 2 or 3 years, which is absolutely amazing. I really want to get into the raising capital portion of this. Like, how did you even start thinking about that? As someone with only a year or two of experience, like, how did you break down that barrier of like, people are going to give me their money?
I actually raised my first bit of capital when I had only like 2 months of real estate investing experience, but I had documented my whole journey of my first property online. So I flew out there, I got food poisoning, got my car broken into, I like showed everybody like all the hardships of real estate. And my mom was actually watching the whole time. And I didn't grow up with a lot of money. I never wanted to ask for money. Again, probably the pride thing. So I went and got a job at 14 years old. And so I would never be the person to be like, Mom, can I use your money to invest in real estate. But she actually reached out to me and said, like, I'm so proud of you for putting yourself out there, for doing something really scary and like actually succeeding on your first one. And she'd like to invest in my next deal. And I was like, what does that mean? Would you be a partner? Like, I didn't really want a partner. And so I went down the whole rabbit hole of like reading Matt Fairclough's book, Raising Private Capital, and kind of listening to different YouTube videos on like what private capital is. And she ended up lending me money for like a fixed debt return. So that was my first experience raising money. She didn't have very much of it. And so after that, I was like, oh, well, used up all the private capital I had. But I started talking on Instagram about, because everyone was curious, how did a 22-year-old buy bikes with no money? And so I started talking about how I used private capital to buy that property. And that's when a bunch of people at the time, I probably had like, I don't know, 5,000, maybe less followers, but people started reaching out to me and saying like, oh, that's really interesting. I have some money to invest as well. Can I invest in your next deal? From there, it snowballed and have raised many millions of dollars now.
Wow. That is the power of just putting yourself out there, and not having that limiting belief. And, I think that's one of the biggest things. I think a lot of times people just have a limiting belief, or you didn't know what you didn't know. So you're like, oh, let's just try it out. Let's just wing it and see what happens. And, it's obviously been successful. I kind of want to get into the numbers here a little bit on your portfolio. Like, you've got 35 rental units. Like, what is that bringing in? What does that look like for you? Because you said you quit your job, you're doing this full time. Like, this is all about financial independence. Like, where you're at now, what does that look like?
It's an interesting question. So if you think about the strategy that I am using, it's the BRRRR strategy, meaning that every single one of those 35 units has to be renovated, rented, and refinanced, which limits cash flow. And so I would say about half the portfolio is actually still vacant and being renovated. And so I don't collect very much cash flow, partially because 100% of the cash flow is reinvested into the business. I would say that if I wanted to collect cash flow, probably somewhere between $5,000 and $10,000 could be paid out. But right now, I'm more concerned about increasing the portfolio, and so not taking those cash distributions. Right now, I mostly live off of like Instagram income that I make from different brand partnerships, from teaching other people how to invest in real estate and that sort of thing.
Well, I think that's important to say because, a lot of people will put out there they have X number of units and they maybe don't have an appreciation of what's going on behind the scenes. They might be able to kind of estimate, average rents, $1,000 a unit times 35. Wow, she's really killing it. She's making a killing in real estate, collecting all the cash flow. But, there's the reality of, you have all your expenses, you have your loans and your mortgages and those kind of things that you got to pay for. And then frankly, half of yours are vacant because you're rehabbing them. So there are all those things to juggle. So it's good to have that perspective put together. But as far as your portfolio goes and some of the business things that you're doing currently, what are some of your goals with reaching numbers and as far as your real estate portfolio goals? Are you trying to get a certain number of units? Are you trying to do a certain number of BRRRRs per year? What does that look like?
Yeah, so it's more of a cash flow number. And so trying to get to $20,000 per month of passive cash flow from real estate, I think that's a kind of a really common number that people shoot for. But this year in particular, we're focused on actually like distributing cash flow, since so much of it has been just recycled into the business. We're aiming to buy around 100 units this year and then focus that really on distributions and not so much reinvestments.
So distributions back to the partners. Okay, gotcha. So back to the partners. And with that, so basically what I'm hearing is if you get 100 units, you're going to be somewhere around that 120-ish, 125 range. And with that, you want your portion of that to be the 20 $4,000 a month.
Right. Yeah. And then we also have talked about like paying down some properties. I think it's an interesting strategy too, because a lot of the properties we buy are like $60,000 and we put in $5,000 or $10,000, but the rents are like $1,000, $1,200. And so potentially even like paying down properties can make a bigger difference in increasing cash flow than buying more properties.
I love that strategy. I've thought kind of the same way. Like, all right, hey, I have this triplex where I'm making $1,000 a month. But if I just pulled all of my money together for the year and paid it off, now I'm getting $4,000 a month. So I'm like, 4xing my income by paying it off sooner. And then once you start adding that up, you can have a portfolio of a lot less size, to get to that number.
Yeah, I find real estate fun. I feel acquiring like properties are fun. Asset management is fun. And so I feel like I want a lot more units than most people who are pursuing financial freedom, who want like the small and mighty portfolio. I probably would have a bigger portfolio than most people purely out of the funness of buying real estate. And also after, I think the goals after I buy a lot of boring real estate. Single family houses are pretty boring. They're mostly cookie cutters now. It's buy them. We do a lot of Section 8 rentals. So it's like government mostly guaranteed rent. But once I hit that $20,000 a month and very boring passive single family long-term rental income, I really want to do more fun, risky projects. And so maybe those like outlandish Airbnbs or building cottages or like RV parks or really whatever. I think that's kind of what my like why is. I don't want to sit on a beach forever because I think that would be really boring. But I guess the safety and the comfort and the stability to be able to make really risky investment decisions and know that I'm still covered at the end of the day.
Well, it sounds like you've worked really hard to build that foundation for yourself. So once you have that built, it makes total sense to step out of your comfort zone a little bit and take those risks that might yield more return. So that's absolutely understandable. I agree with that 100%. Now, when it comes to your portfolio, as you grow it to 100 plus units, are you guys in your partnership going to be self-managing all of these properties, or do you have third-party management in place that you kind of put that management obligation on top of?
So I only self-manage. I still self-manage my first one because I fired that property manager. And then after that, I just thought it was so easy that I just kept it. It's a very easy house to manage. And then we also manage the midterm rentals as well because it's harder to find a property management firm who manages midterm rentals. And the rest of it is outsourced to third-party property management. The partner who is in Augusta owns the property management firm. And so it is essentially as in-house as you can get.
That makes a lot of sense. That makes a lot of sense. I mean, I think for our listeners out there, just thinking about this, it's really what I'm hearing a lot of is like, you said it's touch and go. It's let's try it out. It's fire the contractors that need to be fired, fire the property management that needs to be fired until you find the right person that meets your needs. And also being willing to do some of the work, not outsourcing all of it, but working towards that foundation so then you can do the fun stuff. I think it's really nice to hear someone who has a goal of 20, $250,000 a year, $20,000 a month, and then talking about not just kicking your shoes off and chilling on the beach, building that foundation and then being able to do the fun, crazy stuff. That's exactly how I feel too. It's like, I really think I'll always be buying real estate and always be looking for creative, cool things to do because like you said, it's just fun. I think majority of it is like the challenge of each property and finding the deals and working out all of the stuff. Do you find that to be the exciting part of real estate and why you're doing it?
Yeah, and I think the networking is really interesting. We recently just bought an office building, and I think that's really fun because it's seller finance too, but I come from the office leasing world. And so I find that assets are a little bit more interesting than residential properties. I also used to work in residential real estate in high school, but it wasn't really my jam. And so I think like we almost bought a warehouse last month and we look at these like interesting commercial buildings or businesses all the time. And I think being able to work on those properties are going to be really interesting. And I guess like one step up from the average investor who never gets to that level.
Yeah,
That's
I
great.
mean,
So tell us a little bit about that office building that you purchased, because that seems like a unique deal. Give us a little bit of background on that.
Yeah, so it was just was sitting on the market for a really long time, and it was in Augusta, Georgia, and our partner again needed an office building for his business, and so we kind of bought it as a partnership, and we lease it to his company. So it's like also pretty guaranteed rent. We negotiated a seller finance deal on it, so I think we put down like 20%, and the rate was like, I don't quote me on this. It was like 4.5% or something. But yeah, we also sublease it to the old owner. So the old owner is old and has a firm and rents it out. And
Hmm.
we have our like own tenant who is a partner, so he's going to pay his rent, and he also wants to make the building really nice, and so we have the tenant doing their own tenant improvements, which improves the value of our property without us having to put work into it.
So, for
that's
everybody
great.
listening, this is a great strategy to find seller finance opportunities. Those listings that have kind of just stuck around, hung around on the MLS that are kind of being overlooked and ignored. You might be able to find sellers that are slightly more desperate position. They maybe thought they would have gotten the offer, but they didn't. So, I think that's fantastic that you're able to acquire that property that way.
I think a lot of people also, if they have they don't want to 1031 their money, they're just cashing out to cash out and retire. They don't want to pay taxes on that money. And so if you can offer them a situation where you can give them payments instead of a lump sum of money, then a lot of them are like, great, my collateral is getting my building back if you don't pay your mortgage, and they're happy. So it's a lot of time a win-win for people who are retiring.
So we've
Yeah,
talked a lot about your partnership and your ability to bring together other people to do this real estate thing and accomplish a lot at one time. Tell us a little bit about what you are doing specifically in that partnership and what your role is.
Yeah, so it's adjusted. So when I was in my first partnership, when I was investing in Cincinnati, my job was to do renovations management, which was difficult across the country, and also difficult because I'm really young. I look young, I'm super short, and contractors don't tend to take me seriously sometimes. And so it was a big, I guess, learning curve also because I didn't know anything about construction either. So I actually, when I quit my job, I ended up moving out to Cincinnati for like 5 or 6 months to get some projects done. And they just needed someone to be there on the ground yelling at contractors every day. So I grew to not enjoy that role that much. And as you can imagine, and so in this new partnership, it's really helpful because the partner in Augusta, Georgia, has his own construction firm. And so he can handle the construction side of things. And he's really good. He's filled with a lot of houses, very knowledgeable. And so I'm able to focus only on the capital raising part, which has grown very organically through growing my Instagram presence, educating other people on what it means to be a passive investor. So that's primarily what I focus on, as well as like the asset management side. Instead of yelling at the contractors to get their stuff done, I just have to yell at my partner to make sure he yells at the contractor to get those things done.
that's really great. That's really great. So, what piece of advice, if someone wanted to get started today, would you give someone or tell someone to do first?
I would say like two parts. One, you need to educate yourself, and so whether that means like reading a book, books are really chronological. So it's like step one, step two, step three, or like taking a course, or that like watching YouTube University. And then the second part of things would be changing your surroundings. So joining a mastermind or joining some sort of networking group, because I would say real estate investing takes a different kind of mindset. It is a lot of sacrifice. It's really tough. You come into things where you just need to problem solve and you need to be supported by people. And so if you have one without the other, you'll probably get stuck in analysis paralysis, or you just won't know what to do. And so I think you need to like marry education and a network in order to be successful.
And there's a lot of resources out there for people to meet and form those social connections to create those types of masterminds or social gatherings or whatever. Go to a meetup, go to meetup.com and go just type in real estate meetup, and you'll find a whole bunch of them in your state, in your area, and just decide to go check one out because it'll be worth your time. I've met a lot of great people that I've done deals with through Bigger Pockets, through online, through meetups. Patrick and I, we met at a syndication type of event where we were just trying to learn more about raising money and putting together syndication deals. So you never know. You just got to put yourself out there and be comfortable in those kind of situations.
Have you guys done a syndication?
We have not. It was more of an educational experience. We've been buying our own properties and owning, individually so far.
Yeah, I guess I never talk about this publicly because I'm not sure where it really fits in my content, but I just raised for a syndication. I was a general partner on a 64 unit in Cleveland, and it was a very interesting experience to be on like the syndication side instead of just the debt raising side.
Well, we're here now. Let's talk about it a little bit. Let's crack that nut. So, syndication, maybe just give a little synopsis of what that is, and then what your role it was with getting that deal done.
Capital raiser. It's what I'm good at. But I went to Bigger Pockets conference. I bumped into somebody who I had a casual conversation with, and she was just getting into syndications. And I casually said, well, if you need anyone to help with capital raising, like, let me know. And she actually took it really seriously. We set up a call the next week. And within the week after that, I was a general partner in the syndication, which was really cool. And I raised a bunch of money for them. And it's been an interesting experience from like the asset management side, the document side of things, the legal side of things. It's just cool to be able to peek into someone else's business, and to do that, I guess I earned that right by raising capital for them. But to me, it was like a small task to be able to have a real inside look at someone's business.
That's amazing. I mean, to go from, raising money for your specific deals to raising money from your partnerships to you now raising money for a syndication for, a 64 unit multifamily apartment building. So those levels are just amazing to accomplish in such a short period of time. So for someone listening now that maybe sees themselves or wants to do that down the road, but maybe is looking to continue to build their portfolio and start raising money, what would be, I think most people kind of look at it and go, well, what do I even offer someone to ask them to give me some money? Like if someone's looking to raise money for a down payment, maybe some renovation costs, like kind of what is even the going kind of rate out there for private capital, since you've been so good at raising it?
I think it depends on your level of experience and the amount of people who want to invest in your deals. So early on, I was offering 12% interest, no points, no fees. So it was still cheaper than hard money, because hard money is oftentimes 1 or 2 or 3 points plus 12% plus a bunch of origination fees and closing costs. And so I remember the last hard money deal, I dug up the settlement statement, and it was like $10,000 of fees for like a $200,000 house. It was absurd. So private money, I was like at 12% flat, no fees is pretty good. So that's what I started at when I did not have that many investors. Gradually, I moved it down, and my, I guess, going rate is about 9%, no fees, no points. So it is pretty good. I think it's better than some people are getting in the stock market right now with it on a roller coaster. And a lot of people like that it's backed by real estate. And so, and it's also based off of a relationship instead of based off of the stock market, whatever it does. And so people do like that stability, the constant cash flow, and being able to call me and ask what's going on with their project instead of like looking at the stock market and seeing what the price of the day is.
Exactly. Now, are you paying that out on a monthly basis? Is that on like at the end of the project when you're refinancing? Is that kind of when that percentage is getting paid out to someone?
So I used to do monthly a lot, but I was just talking to one of my friends who does like $1 million flips. And she was saying that she paid monthly too. And if you can imagine, if you have $5 million flips going on at 10%, your annual payment or your monthly payment is like absurd, like $10,000, $20,000 a month. And it's really difficult to manage cash flow because if you didn't raise money to cover the monthly payment, which you probably didn't do, you're having to come out of your pocket for monthly payments. And so we did that for a while, learned from our mistakes, and now we pay at refinance and mostly just to manage the cash flow.
Hmm.
That
So
makes a lot of sense. So go ahead, James.
no, I was going to say, have you had any pushback from your investors? Because, I can imagine that somebody who's just getting into it, they're kind of expecting the monthly passive income. I mean, that's probably part of the reason, but, are most people that are doing the investments with you, are they okay with waiting that period of time before they get paid?
So our terms are 9 months, but we usually repay people around 6 months. And so I feel like 6 months of term is really not that long to wait for their payment. I have other people, like my longest private money debt lender is 3 years and I pay annually. And so on the equity side, we pay quarterly. And so I think there's different models. If you don't have very many options with lenders, I think you might have to concede certain things like paying monthly. And sometimes we do if it's a good relationship. But right now, it's like I usually send out a deal and get it funded within 24 hours. And there's 5 or 6 or 7 people who want to invest in it. And so, because I have so much leverage, I have the deal, I have the relationships, I think it's gotten a lot easier to raise capital.
All right. So basically, for everyone listening out there, you borrow 100 grand from someone for a deal, and 6 months later, you're paying them back 109,000. Or is that
Yeah.
is that the 9% on the
Right.
total amount?
Yeah.
It's
So six
prorated.
months later, I pay them back 100,400 and
Yeah, 45 basically. So you're
thousand.
paying them. Yeah.
Yeah.
So okay, so that 9% is over 12 months. So you're saying, hey, I'm giving you a 9% return over 12 months, but you're paying them back in six, so that's half of the 9%. So that's four and a half, basically. It's only the
Kind of.
nine if they take the whole thing.
Annually. So it's like usually we try to roll a lot of our investors' money into the next deal. And that's kind of the appeal is that if they take their money and then put it back in their bank account, then they did only get 4.5% return and now sitting in their bank account losing money from inflation. And so hopefully the experience is good enough where they want to reinvest their money. Or sometimes investors also invest to, I guess, learn a little bit about the process and get comfortable with real estate. And then after 6 months or after the second deal, they'll take back their money and they'll go reinvest by themselves. So kind of 50-50 what happens.
That makes a lot of sense. And I really just want to hone it down for the listeners out there on kind of how it works, what a going rate out there for money is on a deal. You can start at 12, and then as you build that relationship, 2 or 3 deals later, you're starting to work that number down with your pool. So basically what you're saying is you guys find a deal, you have an email list that you're sending it out to, and within 24 hours, because of the relationships you've built, because of your brand and everything else, you're putting out a deal sheet. Hey, this is what the deal is, this is the return, does anyone want to invest? Bam, within a day you have the funds, and you're raising what it sounds like is 100% of the funds for the deal
100%
and the
of
renovation
yes.
and the
So
renovation.
I would say this is not like the process has gotten significantly easier the more that I've done it and the bigger my brand has gotten, but it didn't originally start that way. The process looks a lot different today than it did in the beginning. But I do have, if your listeners want, on my website, like a free PDF download of the presentation that I use to send out to private money lenders. If they're trying to pitch a deal, I free download, lattesandleases.com. I think it's a good thing that a lot of people, again, the flipper who I talked to actually used it the other day. I think she raised $400,000 in a couple hours. And I was like, that's awesome. But from like a logistical perspective, for people beginning, not like advanced capital raisers, basically it just takes a bunch of conversations. And so whether it's like your mom or your dad or your coworkers or someone, you never know what kind of people are looking for returns on their money. So I think viewing it as providing an opportunity instead of asking someone for money, which a lot of people get scared of, you're actually providing a return, an opportunity for them to build wealth. And then from there, you basically, if they agree to it, you go out. I like to go out and find a deal, bring it back. And then if they say yes, then the attorney draws up all the documents, defines what the terms are. And then I like to give a mortgage as collateral for the investment. And basically the closing attorney handles all the paperwork for you, which is people's like biggest fears. What paperwork do I use? The lawyer handles everything.
So how many investors are you bringing in on a typical deal? Or do you just have a handful, or is it maybe like small amounts from a lot of people?
Just one. So I like to keep things as easy as possible. It depends, like for the syndication, obviously there was a bunch of deals, but the average deal we're buying right now is somewhere between $60,000 and $70,000, sometimes $60,000 to $90,000, let's say. And our renovations are anywhere from like $10,000 to $30,000. And so all in, we're usually underneath $150,000. And so we'll look for one person who has $150,000 so that we can give a mortgage to that person. If you're comprised of like $10,000 investors, one, it's like a logistical nightmare, an administrative nightmare to keep track of everybody. And then you have people emailing you. Usually people who have not very much money are the people who are the most concerned about their money. So they'll be emailing you all the time. And it just gets complicated with like, you'd have to give like 10 personal guarantees for $10,000 instead of actually giving a mortgage as collateral.
Right. And
That
I
makes
was
a
going
lot
to
of
say,
sense.
having a whole bunch of small investors, that would just be a personality nightmare because,
Yeah.
like you mentioned, like the people with little skin in the game, it might feel like a lot to them, but they're going to be your most time consuming investors, I'm sure, 100%.
Yeah, and they're also the type of investors who really just want to invest that you can mentor them. That's another common request is like, can I invest $10,000 and you mentor me through the deal? And it's like, no, I'm not going to pay you to mentor you type of thing. And so I found it a little bit easier to find bigger investors who like might have 300, 400, 500,000. Like my favorite investors have $1 million and I want to build the relationship with them on the $100,000 property so that they want to lend again and again.
These are all like just absolute home run ways for people out there to not only get started, but to see the future and how someone is able to do it like boom, 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 so quick. I mean, you're scaling your business, you're actively growing, like you're doing all of these amazing things. I really have to ask, like, what are some of the obstacles you see yourself facing over the next year, to 24 months to hit that 20,000 number to continue to build your brand, build your business?
Growing pains and scaling. I think always the biggest part is renovations. It's so easy to acquire deals. It is difficult to find enough contractors who do enough quality work at the right price and keep all those renovations on schedule. I've talked to a lot of people who have big businesses, especially with single families, and I think the renovation piece is always the hardest piece. We can mitigate that risk by having it in-house, but there's still the risk of like the backlog of properties or supply chain issues or just prices going up and the market changing. And so I think the renovation side is really difficult to get right and something we're actively working on every day. And then also the market risk, because we can't control what the market does. We can only pivot to what the market does. And so trying to keep a pulse on, is the market going up or down, or interest rates going up or down? And like, what does the supply side look like, and trying to adjust quickly.
So let's talk about contractors a little bit because you've had a lot of experience working through, I can assume, good contractors, bad contractors, but talk to our audience a little bit about what it takes to find a good contractor, and what are some of those things you should really be looking out for? Because as far as I'm concerned, a contractor can really make or break your project one way or another. So, talk to our audience a little bit about that.
Yeah, I've gone through everything with contractors. I've been sued by contractors. I've settled with contractors, all sorts of things. I've had contractors break into our projects after we fired them and destroying the entire interior of the properties. And so I have seen it all, probably not as much as people who've been in the business for 20 years. But I would say limit the amount of money that you give them up front. So don't like, this is an extreme example, but if you gave them 100% of the payment day one, what is their incentive to come back and do good work? They're probably just going to run away and dissolve their LLC and ride into the sunset. And so I think trying to limit that upfront payment and also putting them on a pretty strict draw schedule to pay upon completion and not to pay on like timelines. So not like 1 month from now, I'll give you $10,000. It's more like when you finish the rough and plumbing, I will give you X amount of dollars, and really defining that payment schedule beforehand so there's no chance of disagreements when you get there.
I think that's very solid advice. I'm usually like the max would be like a third, a third, a third, for the small interior type renovations that I'm doing with like painting, drywalling, stuff like that. Like, hey, the first third's for materials. The next third is when, we're halfway through, and then final at the end type of thing, at least to limit yourself. Because like you said, you see horror stories all the time on forums of people giving contractors, 10, 20, $30,000 before any work even gets done, and them crying the blues later because they got screwed.
Happened to me. You live and you learn, but learn from this and don't make the mistake. But the other thing I would say that I'd never hear people talk about, but don't enter into relationships with contractors because you're desperate. And so if it doesn't start out well, if your relationship is really heading like butting heads in the beginning, just imagine how much worse it's going to get halfway through the project when there's a disagreement on a change order. And so that's something that I've learned. It's more of like an intuitive thing that you have to get really used to. But if you are arguing, a lot of the time, when I was younger, I mean, I'm still young, but in the beginning, I would just rush into projects because I would feel the urgency of wanting to start now and like feeling the desperation of getting started on the renovation and not losing any time. When in hindsight, I should have listened to the feeling that, this relationship is not going well and I need to cut the losses and move on. So I think that's something that would have saved me a lot of money back in the day.
Man, this has been packed full of fantastic information, fantastic inspiration. I know I'm motivated to go out and do more. I'm already feeling like, man, I could be accomplishing so much more. And this is a perfect segue into the next segment of the show that James and I like to call the Big Four. James, take it away.
Soli, so for the first question, I want you to tell us something that you do that feels like a financial independence hack, something like a cheat code that really helps propel your finances forward.
I would say real estate professional status, being able to write off essentially all income and paying no taxes.
That is key. If you can achieve it, do it. Work 750 hours, Patrick? 750 hours to get,
hours.
Yeah, to get that designation. Track it, get it. You'll make so much more money the fewer taxes you pay.
A lot of cost segregation studies in order to write off all the income.
Yes, as someone who has been real estate professional status for the last 2 years and done cost segregation studies as well, I can attest that it is absolutely amazing. And for someone who is also married, that passes through to my spouse's income as well. So it's amazing. What a great one. That's the first time anyone said the real estate professional status. So love your answer for all of our listeners out there. We call this next one resources. So are there any particular books, podcast or people that have shaped your financial independence journey, just your overall kind of mentality of dealing, with growing, scaling, all that. Besides Rich Dad Poor Dad, everyone knows that one, or How to Win Friends and Influence People. Like, do you have any other books, podcasts, or people our listeners could benefit from going and checking out?
I feel like this is also probably said, but Bigger Pockets is a really good resource. The other thing is just Instagram in general. I think a lot of people don't think about how they curate their feeds because they have their friends and their family and cute cats and cute dogs. But I've curated my feed to be only real estate people. So my world is full of people who are taking action and taking risks, and it has completely changed my life. So I think that if you want to create a separate Instagram where you can curate your feed a little bit better to personal development, business, and real estate, it can make a huge difference in your life.
That is fantastic. Surround yourself with the content you want to be. I mean, it's pretty much that simple. Also, for everybody, don't become too distracted though with social media, of course. But for this next one, we call this one the future you. So I want you to paint a picture of your life in 5 years. Like, what are you doing business wise? What does your life look personally? What kind of things do you got going on in 5 years?
My out there dream, I guess, is to build a health retreat in Santa Barbara. And so I guess it's a real estate play, but also to be in a place where I don't need the cash flow to come in. And again, goes back to like taking bigger risks and working on things that I'm really passionate about. So like health and wellness and stress relief and beautiful places. And I would love to build something like that, say 5 years from now.
Wow, that's fantastic.
That's great. You get kind of the best of both worlds. So amazing, amazing, amazing. All right. So for everyone out there that hasn't heard of you before, I know you've mentioned it a few times throughout the podcast, but if someone wants to, say they were inspired by this podcast, if they want to reach out to you direct, if they want to check out that course about raising private capital, your beginner's course, like where can anybody find you that they already don't know who you are?
Instagram, YouTube, my website. It's all pretty much lattes and leases, and you can find me there.
Amazing, amazing, amazing. Everybody go follow her if you're not already followed her. Subscribe to her YouTube channel. And you guys know the drill. This podcast and this information that we are giving you guys is all free. All we ask is the payment that you give us is by going and subscribing to our YouTube channel. Subscribe to our newsletter that we put out every week, following us on Instagram, writing a review, leaving a comment. Just do something as payment to James and I and our amazing guests that we bring on to you guys each and every week. And with that being said, we'll catch you guys next time. Peace.
Hey, guys.